Good morning, everyone, and welcome to our DAT IQ Weekly Market Update. This is our update for April 12th, 2022. I'm Ken Adamo, Chief Analytics here at DAT, joined as always by Dean Croak, who's our Principal Industry Analyst, and Ned Damon, who's our Principal Data Scientist. Good morning, gentlemen.
Howdy.
Good morning. Hey, Ned. Good morning, Ken.
It's a good morning indeed, because I have two bits of information to share. One, it's going to be 70 degrees and sunny in Northeast Ohio. And two, I didn't fail out of my first semester of grad school.
Oh, congratulations. Well done.
Which is what I was fully expecting. It's all uphill from here.
Oh, exactly.
I heard you had a little bit of a weather calamity, Ned.
Yes, I wish to offer a personal and heartfelt apology to the residents of Atlanta, Georgia, for making fun of their inability to drive several years ago in 1 inch of snow, because we had approximately 1.5 to 2 inches of snow here in Portland and everything shut down.
Wow. I saw that. Like, you could still see the blades of grass, and they're like, my power's going out. I don't know what's going to happen. I don't know if I'll be able to eat tonight. I'm like, okay.
Yeah.
I mean, like, people lost power. They're not making it up, but yeah, no, it's 2 inches of snow.
Maybe that's because we're in Bloodbath 2022 Freight Edition. Maybe there was no capacity to ship that's not how that works. Anyhow. No. All right. So for those unfamiliar, we're here every Tuesday, except I won't be here next Tuesday, talking about trends we're seeing in the freight markets, what's going on out there, but most importantly, answering your questions. So if you have any questions, non-weather related preferably, drop those in the chat. We have a wonderful marketing team who will send those over to us behind the scenes, and we will answer them accordingly. So with that, I'm going to go to our key points of the week, which are located over here. Dry van and reefer spot rates continue to dip. Last week, somewhere around the middle of the week, on a daily basis, was the first time that we were year-over-year negative for dry van and reefer since June of 2020. If you remember, that's when we were digging out of essentially the first wave of COVID, the toilet paper crisis of 2020. Load post volumes are actually, kind of hovering around 2018 levels, but some of that equipment post stuff is getting towards 2019 levels, which is a bit interesting. Cold weather impacting started produce. Also, fertilizer shortages, I'm hearing. We've been talking about that a bit. Perhaps a blessing in disguise. New truck orders a bit over month, but down year over year. Could this be the market helping it from itself? We'll see. And then tide turns, some information about port shortages, port activity, which I'm sure Dean will cover here in a second. But with that, I will turn it over to Dean to make some sense of this all. Dean?
Yeah, thanks, Ken. Let's get started with our load-to-truck ratio in the dry van sector. Load post volumes are getting close to 2018 levels, but equipment posts are already at 19 levels, so the load-to-truck ratio dropped again this week, down from 4.3 to 3.41. That's about 4% below 2018 levels for those that track the long-term trends in the load-to-truck ratio. Having a look at the refrigerated sector, load posts were down also last week, but it left the load-to-truck ratio largely unchanged at about 6.57. Load post volumes are down about 38% year over year. Colder start to the produce season, as Ken mentioned, in the southeast, undoubtedly playing a role in lower produce volumes. But it turns out that even though we're down 22% year over year on the truckload volume side, we're returning to more normal non-pandemic levels. Having a look at the flatbed sector, load post volumes dropped also last week, down about 20% in the last 4 weeks. The load to truck ratio dropped substantially from 83 to 62.98. Having a look now at our market index, having a look around the country, we'll start off on the West Coast in Los Angeles. Rates continue to slide, down 9 cents a mile last week, averaging 234. According to the latest data from IHS Market Peers for March, Port of Los Angeles and Long Beach accounted for 34% of inbound loaded containers. Volumes are up 16% month over month. On the key lane out of Los Angeles to Chicago, rates dropped almost $1 a mile since the start of this year. Capacity has loosened considerably. Rates are now averaging $2.05 per mile. It's also 36 cents a mile lower than this time last year on that key intermodal lane where truckload competes. Over on the East Coast, New Jersey was the number 2 port for March volumes. Volumes were about 17% of the national total. Month over month, volumes were up 22%. Similar to the West Coast, capacity loosens fairly considerably over the course of March. Rates have dropped by 13 cents a mile in Elizabeth, New Jersey, now averaging $2.08. One of the markets that had a lot of tightness in capacity this week was Huntington, West Virginia. Rates were up nearly $5 a mile for loads 600 miles north to Toronto. We're still seeing the ripple effects of the Canadian blockades continue to be felt in many US markets. Out of Huntington, one of their largest exporters on the trade side is Canada. We see a lot of plastics, machinery, and chemicals head from Huntington across the border into Toronto. After averaging about $2.20 a mile for most of last year, spot rates have jumped to $4.95, excluding fuel, increasing 81 cents a mile since the start of April. So very tight capacity for loads north into Toronto out of Huntington. Having a look at the produce market, even though import volumes from Mexico are trending upwards towards their seasonal April-May peak, they do remain down about 4% year over year. We covered already that volumes are down 22% on the overall volume side. There is a definite trend back to eating out. I think that's no surprise to everybody. Cooking at home is certainly on the decline. Grocery sales have dropped 6% in the last month. The very important ship-to-home grocery sales segment is down 30% year over year, following a 13% drop in orders in March. So we're definitely seeing a return to the food services sector, especially on the fruit and vegetable side for refrigerated carriers. That will change the mix and volume of freight as we get back to more normal levels. Volumes across the southern border in Texas were up slightly this week. Markets were tightening on the spot rate side. Regional rates out of the Laredo, El Paso, McAllen market, where a lot of produce comes across, volumes were up, pushing up spot rates by 7 cents a mile to an average of $2.90 last week. They're up nearly 40 cents a mile since February for loads from Laredo to Los Angeles. Similar trend, Laredo to Phoenix, another big lane, averaging $2.43. Capacity was pretty tight last week in the Pacific Northwest. Again, no surprise here in Seattle. It's Lent. Lent started last week, so demand for Alaskan pollock jumps this time of the year, pushing up spot rates in the reefer sector by about 20 cents a mile to $1.84. Having a look now at the flatbed market, we'll take a look at our Houston market. That's our largest flatbed market. Capacity remained pretty flat last week, while loads moved on the number one lane in the flatbed sector from Houston to Fort Worth, increased 4% week over week. Higher truckload volumes on this lane had the opposite effect on rates, though. Plenty of capacity. Rates dropped 8 cents a mile to $3.40. On the second highest lane out of Houston to El Paso, loads moved decreased by 10%. The capacity was the opposite. It was much tighter. Rates were up 10 cents a mile to an average of $3.18. Having a look at the oil field market in Lubbock in the Permian Basin, rates were down 35 cents a mile in the last week to an average of $2.86. Still 20 cents a mile higher year over year. There is some more drilling activity in the Permian. If you have a look at the latest Baker Hughes drilling rig count, there were another 18 land-based wells added last week. The total drilling wells is up to 675. That's 254 more than this time last year, but we're a long way shy of the record 2,026 drilling rigs over 10 years ago in November 2011. So not a lot of activity there to report in terms of flatbed demand for drill pipe and casing. Having a look now at our year-over-year spot rates, dry van contract rates have plateaued and are now about 32 cents a mile higher than spot rates this week. The spread is about 20 cents a mile in reefer, with spot under contract for the first time in 12 months. Spot rates turned negative, as Ken mentioned, down 3% or 6 cents a mile compared to this time last year. They ended last week at $2.28, excluding fuel, with some more room to go, as Ned will cover shortly. Having a look at refrigerated, rates dropped by 32 cents a mile in the last month, down 7 cents a mile last week, now averaging $2.56, excluding fuel. For context, that's still about 69 cents a mile higher than the same time in the previous 4 non-pandemic years. So historically, rates are still high, although trending down. In the flatbed sector, flatbed spot rates hit a record high of $2.75 on Independence Day last year. And following last week's 5 cents per mile increase, rates are now just 3 cents a mile below the 2021 all-time high. They ended last week at $2.72, excluding fuel, and are now up 5 cents per mile year over year. That's it for this week's market update. Remember, if you'd like to find out more about what's happening in freight, go to dat.com/market update and download our weekly report. And with that, it's over to you, Ned, for the short-term forecast.
Before I dive too far into the short-term forecast, I want to remind people that if you want your questions answered, please do get them into the comments section in whatever platform you're watching us on. We have people who will catch them, and it's the earlier you get them in, the more likely you're going to get them answered. Without further ado, we're going to begin by talking about the dry van forecast. In blue, you can see the market rates observed by DAT, and then off to the right, you can see our 4 different forecasts. In red, you can see our short-term forecast is expecting basically the trend to continue into the foreseeable future, with rates ending, looks like about 40 cents a mile below where they are in the early part of May. Next in green is our Ratecast forecast, which is our flagship forecast. Ratecast sees that there's a little bit more of a drop left, looks like about 15 to 20 cents of drop, but then a leveling out as we start to move into May and the start of summer-ish. Finally, in gold and silver are our 2 blended forecasts, which are mixtures of the short-term and the Ratecast forecast in different amounts and in different ways. The short-term here is leaning more towards, the blended forecasts here are leaning a little bit more towards the short-term, although they are breaking a little bit as you move into May. Overall, I tend to lean more towards the Ratecast forecast here. Although the short-term forecast certainly isn't out of the question, given the way that things have been sliding. Next, we're moving on to reefer. Once more, you can see in blue the market rates observed by DAT, and then off to the right, you can see our forecasts. In red, the short-term forecast has that same pattern that you saw for VAN, continuing downwards, dropping by about 50 cents, it looks like, over the next month, which is a little bit surprising, but we'll see how that pans out. In green, you can see our Ratecast forecast is again expecting another 2 to 3 weeks of drops before it corrects as the produce season starts to come online, dropping by about 7 cents, and then rising back up to current levels in the middle of May. Finally, you can see the blended forecast, which are mixtures of the 2 in different amounts and in different ways. They're leaning a little bit more towards the short-term forecast initially, and then they're breaking as produce season comes online, but it's not quite enough to stop the slide, ending about 30 to 40 cents below current levels. Finally, we talk about flatbed. Once again, in blue, you can see the market rates observed by DAT, and then off to the right, instead of sharply diverging, very aggressive lines, you can see a much tighter set of model agreement, which I like to see. In green, Ratecast is expecting a little bit of a slide by about 5-7 cents before rates pick back up in the later part of April, returning to about where they are right now. Short term is expecting more or less a flat pattern. Short term is again in red, a flat pattern with a slight drop by about 2 cents over the next month. And then the gold and silver blended forecast, which are mixtures of the 2 forecasts in different amounts and in different ways, are leaning a little bit more towards Ratecast, although they're leveling out a little bit below where Ratecast is landing. And with that, it's time for our IQ question of the week, which is, do carrier operating costs represent a floor for spot rates?
No. Bye, everybody.
I mean, so Ken, you are absolutely right. At a certain level, though, if rates are sufficiently low and operating costs are sufficiently high, there will be an amount of marginal capacity that will tend to stop capacitying because it's no longer profitable to do so.
Right.
Yes. So I think this is a very important question to break into long and short term, or like long run, short run economics. Again, I didn't totally fail that first semester. Let's just talk about short term for a second.
Yeah.
I can't think of a single time that I've been working in this industry or that I've been studying this industry. So at least 10, so 15, in the last 15 years, where short-term spot rate movements, or even contract for that matter, were backstopped by any fundamental cost assumptions. Can anyone else? Well, Dean's been doing it a lot longer.
Right. No, there's always a race to the bottom. There's always someone that'll take a load cheaper when the capacity loosens like this. Remember, it was only 2 years ago in May, we had carriers protesting in front of the US Capitol about record low spot rates and lack of transparency in the market. So, yeah. So
were they protesting because they were still running profitably? No, right? No. The market didn't care. The market. So I am so strong in this belief because I believe that the spot market especially is an efficient market. There's no conspiracy, there's no collusion, or at least there's no overwhelming Like no one party can impact the market in a way to sufficiently disrupt it from where supply would ultimately meet demand.
Right.
That's kind of the overall definition of an efficient market. Is it as efficient as it could be? No, because to Dean's point, there's a lot of irrationality. The product isn't 100% a commodity, right? Especially when you start to getting into the specialized modes, which is why flatbed doesn't tend to react in the same way as dry van and reefer. But in the short term, it's where ultimately, like if you want to get real technical about it, and I'll kick this out to the both of you to see what you think. I would say short term, trucks will run until their variable cost bottoms out. So their actual running cost per mile, taking out their truck payment and their insurance and all that. The fuel and whatever they prescribe as their running cost, they will run until that bottoms out.
Yeah. Or in less technical terms, when you generate enough cash to pay your fuel bill at the end of each month. That's kind of when that plays out.
I mean, in my career, I've seen loads moved for like fuel plus 10 cents out of Florida.
Exactly.
Like verified freight loads, right? Because at a certain point, your variable cost could be paid, and you're just trying to get back to a point and try to get one more shipment that month. And you're willing to ignore, whether it's on purpose or not, ignore your truck payment, your insurance, and all of the other kind of fixed costs to just make a profit in the short term. Eventually, you'll run out of business, though.
Right, sure. To that point, though, there are some loads, and talking about Florida, I think is a good example, where people will run below variable costs for short periods. And that's something that can put pressure just to get back home, so they're not running empty. Yeah,
I think that's a good point, Ned. I mean, people will always run suboptimally to get from a backhaul market to a head haul market, or even back to a balanced market. I think the broader point, though, is let's just let's use the shortest unit of measure as a week. So what on average, Dean? 3,000 miles a week?
Yeah, 3 would be at the high end for most, I think.
Yeah, 2,500 to 3,000 miles. Yep. There is no cost backstop to those 3,000 miles, in my opinion. I mean, short of, again, your short run variable cost. But I do think long-term rates are guided, especially on the contract side, by the overarching cost to run a firm, right? A carrier, whether that be an owner-operator or Swift, Schneider, Heartland, any of those big carriers. Would anyone disagree with that?
No.
So that puts us in a bit of a pickle, right? We've sort of set up the rules of the game in a way where short-term costs are driven by supply and demand, efficient market hypothesis. Long-term, they are kind of driven by the systemic overarching market fundamentals. But why is it that from 18 to 20, we saw an entire, let's go way back. From 16, the last major dip, we looked at the long-term charts last week. From that last major dip to the big crest in 17, 18, why did we dip down largely, plus or minus a few cents, where we were in 16, 17, when it all started? Why was there no systemic inflation?
I mean, the Ned take on this is that actual inflation was very, very low during that period. And fundamentally, it's a dynamically stable system, right? Like over a sufficiently long period of time, there will be entrants and exits to the point where the system will tend to maintain parity. As prices go up, more entrants enter until the system can't handle that capacity anymore, and then it'll dip down and people will leave the market until it returns back to stability. And that's one of the kind of theoretical bases for a lot of the models that we use, is that over the long term, things are dynamically stable.
Right.
Is that
I mean, I think to bring it into layperson's terms, there weren't a ton, and I'm sure someone could post an article and disprove me and find a driver. There certainly weren't. I'll plant this flag in the sand. Is that even whatever. We'll run with it. There weren't nearly as many driver pay increases. There weren't as many, and there weren't as significant driver pay increases among the big contract, leased, and employee fleets between 16 and 18. I was there, right? We were very hesitant to put a long-term, right? Because what you're doing is you're making a call. As a manager, you're making a call that something has fundamentally changed. The price to get a driver through the door and have them run for you is higher. So it's nearly impossible to claw back those driver pay increases on its face, right? There's other things you can do, but so what have we seen since 2020, early 2020?
Multiple record high pay increases. Yeah. Right.
I think Forward Air's done 3. Schneider's been very public about doing multiple across all of their modes and divisions, right? And we're not just kind of waxing poetically about how the market works here. There's a point. I think there's a lot of fear-mongering around, we're going back to 19 because the underlying market fundamentals, if we only look at supply and demand, it looks just like post-18. But I think it's really important to be mindful of, like, where is that floor going to be? Do I think we're going to find that before the 4th of July? No. I don't know if anyone disagrees. I think we find that where we start to settle probably somewhere this summer or next February, depending on how long this down cycle is. Thoughts? I want to make sure that I'm not dominating. I want to make sure I'm with you guys to...
Yeah, no, Dean, go ahead.
I was sort of struck by some of the data we pulled from the USDA yesterday, that because I was perplexed as to why year-over-year comps on the produce side were down so much. And of course, year-over-year comps being negative to the last 2 years are totally understandable. So I went back and looked at the last 10 years of produce volumes for the month of March. Turns out this March, we're pretty much where we would be in any non-pandemic year. So there's a return to normal on the produce side. And of course, when you think about the excess capacity we've had in the market, especially on the refrigerated side, and how good rates have been, there's no wonder that rates have dropped 50 cents a mile if volume is dropping back to pre-pandemic levels, as people eat less at home, cook less at home, and eat more at more efficient restaurants who tend not to waste as much.
Yeah.
It's a fairly nuanced subject. I'll be writing about it next week and digging into some of the shift. But it looks like, on the face of it, that we're just returning back to pre-pandemic demand levels at the moment, especially from March.
That's a great point. I mean, go ahead, Ned.
Oh, I was going to, add to that. We're going back to pre-pandemic demand levels, and then the throughput in the market is also stabilizing. Like, one of the big reasons why there was this issue of, like, less capacity available, it wasn't necessarily because there was fundamentally less capacity available. It's because the capacity wasn't able to be used as efficiently because there were all these market dislocations. And as we start to move back towards normal, the networks start to get more efficient.
Yeah, more fluid. Yep.
Yeah, I mean, these are all really great points. And I think, look, we need to be mindful. We don't know. Look, again, this isn't a screaming hot take. This isn't a smoking gun. We don't know where this market is going to settle. By all indications, we are in a sinusoidal curve, right?
Yeah.
We are in the period where we should be declining until things bottom out and reach an equilibrium. I think it's a blessing in disguise that a lot of these Class 8 truck orders have been held up with part shortages and whatnot. That was, in my opinion, the main driver. People way overbought in summer of 2018, and it just absolutely crushed rates. I think drivers have been given these pay increases. Those is a very different problem we're probably going to be talking about in the fall, right? Because as rates fall, especially, primarily contract rates, these carriers are going to be left holding the bag. What do? Right? They've increased their operating costs significantly. And the days of 85, 75 operating ratios are going to be long gone. So where we settle probably sets a new floor for the next 5 or 6 years, I would guess. I mean, I don't suspect, again, I don't have a crystal ball, but I don't suspect there's going to be a lot of driver pay increases over the next 5 to 6 years. So we will probably operate in a sense of a normal freight market about wherever these new points are set. Because frankly, we operated around the old level since 2013, 2012, Dean, right? Probably.
Correct. Yep.
We saw a little bit in that kind of Superstorm Sandy kind of put like a nice little hedge in place. And that was what, 12, 13? I don't remember. But anyway, we'll keep an eye on it. We're keeping an eye on it. Be mindful that the new bottom most likely won't be the old bottom. But if it is, we're in some serious bizarro world.
Yeah.
I think also this is prudent advice with just about anything, whether you're reading about interest rates or mortgage rates or any of that. Be wary of people who are in business to generate clicks and fear. And I mean, it's people who benefit from your misery. So there are things you can do, whether the market's going up, down, or flat, to be successful. This is a cyclical market. Anyone who's been in this business for more than a year and a half, 2 years, has experienced an up and a down. And they've gotten through it. Now, sure, there are small carriers that have went out of business here and there. I would tell you that this isn't like 50% of all carriers are going to go out of business. We're talking about, what, Dean? At the most, low single digits, maybe.
pretty small percentage overall.
Which I don't want to minimize it. I don't want to be insensitive to that low single digits, to someone in that sample. That is a terrible thing to have to go through. But we are not talking about bread lines here. So let's just be mindful. Maybe have a little bit of faith, as hard as that is for me to say, in our Federal Reserve, and that they're going to guide us through this. And we'll get there. It will be all right.
I just wanted to add that. Oh, pardon. Go ahead, Dean. Sorry.
I was just going to say the basic fundamentals of owning and running a successful trucking business haven't changed. Maybe the cost structure has, but there's still niche markets to find. There's still ways to generate a successful business even in downtimes like this. So I don't subscribe to the doom and gloom, the sky is falling sort of Chicken Little mentality. I think there's always an opportunity in trucking if you can find a niche market and overservice it. You'll always be very successful. But underlying all of that, you've really got to understand your operating costs. Well, it's the same for any business, but carriers in particular need to be pretty mindful of that.
Or you don't understand your operating cost and, go out of business.
Price yourself out. Yep.
Yeah.
So I had just two tiny points. First was on the long-term leveling out. That is dependent on inflation going back to reasonable normal levels. Like if there's sustained high inflation, then I don't think that the market can sustain the level that it does, because the fundamental cost of literally everything will go up, and you can't just hang on to your operating costs at whatever level they're at.
Yeah, I think it's important, before you get to your second point, to address. Yeah, I think that's the point we're making. Obviously not well. I appreciate you chiming in, right? We're not saying where it's going to settle. We're just saying that, like, these underlying market conditions, like macro market conditions, not like our MCI product or anything like that. These macro market conditions that we're all experiencing will be a major driver for long-term rate inflation in the trucking market. Not how many trucks are on the load board, or you know what I mean? Like that's not what's going to drive long-term. It's going to be inflation. It's going to be interest rates. It's going to be insurance. It's going to be, I don't know, regulatory issues like ELDs that impacted fleets. Anything that impacts the underlying cost base of an operator will impact baseline operating costs, which we believe drive long-term market outlooks.
Yeah, and then the second point was on the carrier bankruptcies. I mean, capacity has to get withdrawn one way or the other, and there are definitely ways that capacity can go down short of bankruptcies. Like people can idle trucks and do other things.
Yep.
But yeah, no, like if there's a sustained rate drop, then there will.
Awesome. All right, we have one question from a loyal listener. I want to make sure we get to it.
Mihailio J asks, pardon, what will happen if demand drops to pre-COVID levels because there is far more capacity in the market? Bankruptcies?
I don't know that there is far more capacity in the market.
Yeah. I mean,
well, we should run the show back. It's a good question.
Yeah,
I think. Let me be a bit of a television news presenter here for a minute. Or a politician, I should say, a debate level politician. I don't know that I can tell you what will happen, but I'm pretty sure I can tell you what won't happen. We won't go back to pre-level rating conditions. I think if we snapped our fingers and put everything back in place from like a short-term fundamental market condition, so the same number of trucks, same amount of demand, I do not think we would go back to the same pricing levels. And maybe that's a hot take. Maybe I'm wrong. But I just think too much has happened, right? The horse hasn't just left the barn. It went for a stroll. It's gone feral, right? This is not the same. I mean, again, I don't want to get too poetic here. This isn't the same country that it was pre-pandemic. I mean, we've been to gas stations. We buy milk and groceries, right? We are experiencing generational inflation. So I don't know that we can say that it would go back.
Long-term changes in how freight moves. You're seeing a much bigger shift towards, more volume coming across the southern border in Mexico. Freight markets are shifting. You're seeing more volume in port markets than we've ever seen before. There's long-term shifts here that will be there for a long time.
Yeah. So it's not a bad thing, right? It's like if you're not cognizant of it, I'm going to leave with this because we're running up against time. The worst thing you could possibly do right now is like live in a house with no windows, right? So if you're sitting there running a pricing desk for a brokerage and you're bidding the same price you were in February, I bet you're losing a whole bunch more bids than you were then. because brokers, brokers that are in tune with the market, brokerages that are sophisticated, which doesn't mean you have to be big, but brokers that are paying attention to the market are starting to bid their forward freight lower than current market conditions.
Right.
And if you aren't on that bandwagon, you are going to start losing out on freight. You're not going to have enough contract freight to balance out your portfolio. You're going to be more exposed to the spot market. The spot market's down, revenue per shipment down. You don't get to take advantage of the margin expansion between contract and spot. You're all of a sudden catching it from both sides.
Mm-hmm. Yep.
So we could do a whole tips show, hot tip off of like things you should be thinking about right now. But all of it relates back to like you need to be plugged in to what's happening in the market. Mm-hmm. And certainly do not, okay, look, I'll leave everyone with this. Do not submit an RFP under a cost regime that matches 2019. You will lose a lot of money. You will lose a lot of money. I can't guarantee much, but I could darn near guarantee that.
Right.
If you assume we're going back to 2019 spot levels over the next 12 months, we may end the next 12 months there, which would let me off the hook a little bit. I highly doubt it, but we might. But it is not going to look like from 4th of July 2018 leading into January, February of 2019. It's just not.
Right.
Or it might. Who knows? All right. Plugs.
Yeah. We'll be on Landline Now at 7 p.m. Eastern tomorrow night on Sirius XM 146 Road Dog channel. Same 8 a.m. Thursday morning on Radio Nemo, Talking Freight. Of course, we're on Sales Chatter Live. It's Data Wednesday tomorrow morning with Dan Deegan and DJ Flores. And on Thursday, I'll be on with Bill Cassidy on the Journal of Commerce, having a look at the trucking market first quarter review. We'll be on at 2 p.m. Eastern. Just go to joc.com and have a look at their webcast calendar.
Cool. I know TIA went off without a hitch. I was kind of heartbroken that I wasn't there, but again, I was not failing out of college at that point. So I'm looking forward to seeing everyone at the trade shows through the spring and summer. I should be able to attend the lion's share of those. So with that, I'm going to sign us off for the week. I won't be here next week. We have a surprise guest host holding down the fort with Dean. I think Ned will be in the air with me, so he won't be here either, but that should be super fun. All right. With that, we're going to sign off. Hope everyone has a great week. Stay warm if you're in Portland, and enjoy the sunshine if you're in the Midwest. Bye, everyone.
All right. Thanks.
Bye.
Have a good week.